Ed, good to have you back on the show. So let's start with your guys' overall opinion on stocks, which when I read through your note is bullish, but a little bit of reserved bullishness, it feels like. So walk me through the case for equities.
Yeah, so we've got a lot of positive developments over the last several weeks. In particular, earnings expectations, which were pretty high when you're looking at for the Q4 and into 2020, those have come down quite a bit to the point where they're pretty reasonable. Estimates for next year are in the range of 11-12%. They may seem high now, but really the reality situation is estimates come down throughout the year. So that if they end up in the mid-single digits, the market can digest that fine. Recession fears have gone away. What still gives us a little bit of caution is that with the latest rally, our sentiment composites have gotten a little bit more optimistic. So while the overall model is positive, as we see here on the screen, our sentiment has gotten a little bit frothy. So what we'd like to see is with a little pullback in the markets, a pretty big pullback in investor sentiment, and that'd be a great launching point for the final stage of the year-end rally.
So the red line here we're looking at is your guys' metric for the bullish nature of this. We can see that it's dropped a little bit at the start of the year. It's worked its way back up. A blue line on top is just the S&P 500. Ed, when you talk sentiment, is that more about positioning and allocation, or are we talking survey data and stuff like VIX positioning?
It's actually both. So you've got the American Association of Individual Investors survey in there. Consensus Inc. is an institutional survey, but we have the VIX put-call ratio. So we include all of it. Not to get too much in the details, but we normalize the data. So everything ranges from 0 to 100. So a high number means optimism, low number means pessimism, and it's crept into the optimistic zone in the last couple of weeks. It's not the kind of levels we saw, for example, in early 2018, that was near record high. We're not nearly to those levels,
right.
But historically the market struggled when it got a little bit optimistic. So again, we're looking for a little bit of a better launching point.
One of the things that we've been talking about here, Ed, I've been watching the valuation for the stock market that had been trending lower since that frothy Jan 18 peak. What's interesting about the latest batch of highs here at 3,100 is that valuations are back above 20. That's the highest since September, trailing 20.5 for the S&P 500. So look, it's not as wild and exuberant as Jan 18, but when you combine the valuation on the trailing basis with if you look forward with earnings are still dropping for revisions, how do we marry these two together to feel comfortable about the elevation for stocks? Because our forward look for next year on earnings keeps dropping.
Yeah, well, actually, I view that as not necessarily a negative thing, because earnings we think are going to be in the mid-single digits, which tracks nominal GDP, because without margins changing, that's pretty much what you're going to get. The concern would be, for example, if we go back a year ago, expectations were really high, up in the upper teens, and that was just too much. And so the expectations had to come down. The fact that they've already come down to a fairly reasonable level, we think is actually a pretty good starting point. Because if you go back to the mid-'80s, the average miss is around 8%. So look, we know the drill. Analysts are off the year too optimistic, and then they get more realistic as we go. So the question is, are our estimates so high that we're going to drop more than that 8% average? And here we are, around 11.5% for next year. I think that's a pretty good spot to be for right now. But Oliver, I think what we've talked about before, the other wrinkle to this is where interest rates go. If interest rates stay pretty contained, then stocks are going to look really attractive relative to bonds. If we start getting above 2% on the 10-year and even higher, then those high absolute valuations for the S&P that you were alluding to become more of a front burner issue.
With the chart we're just looking at shows that consensus estimate. If we bring it back up again, the gray line in the top shows the calendar year 20 estimates that have been coming down. The pink line right below it is 2019. The blue 2018. You can just figure that as we go down along for viewers. Obviously, the big tax cut we see the pop up in 2018. Your point, Ed, is that generally we do see revisions come in throughout throughout the year. But again, just to kind of put this next to rates too, because I think the point about rates is important. But didn't we just hear from the Fed, Ed, that Jay Powell's not going to do any more cuts? So on a comparative basis, isn't our bond comparison for valuations also not being terribly accommodative if we've seen the cuts and there's no more additional valuation expansion to come vis-a-vis the Fed?
Well, yeah, of course, the Fed's looking at short-term rates. I was thinking more along the lines of the 10-year long-term rates. If those stay contained, I think stocks will be all right. If you're looking at just the Fed cycle, actually, the market's done well if the Fed cuts 2 or 3 times and stops, because that means the economy is doing okay. They don't need to do more. It's actually, if they have to keep going, that means we're probably heading into a recession. So if you look at, there's 3, I think, really good comparables. In 71, there were 2 quick cuts in November. In 95, 96, there were 3 cuts. And then in 98, there were 3 quick cuts around long-term capital management and Russian ruble crisis. In each of those cases, once the Fed stopped, the market rallied. In fact, you're up over 20% 1 year later. Of course, you didn't get a recession in any of those cases. So if that's a scenario we're in, where the Fed puts some insurance in the market, I think that's a pretty good news for the next year. Now, after that, things get a little bit dicey. If you think it's late 71, well, we rallied into early 73. We didn't cross that January 73 high, excuse me, until 1982. And then in 98, of course, you had a monster rally in 99, and then you went to the secular peak. So the Fed can't do this forever, but at least for the next year, 3 quick cuts and that's it. Actually, isn't that bad.
And a point about contained long rates, the sell-off since September. I know this week we've gained some footing for bonds and gold, but the sell-off moved so quickly without any big acceleration of economic data. It was more just stabilization, I think. We had a decent manufacturing bounce back, but nothing's improved with wage gains. Nothing's escalated with inflation. Nothing's changed for employment, but yet the 10-year moved quick. Now it's on hold this week again, but can we say with confidence that rates are contained in this environment?
I think 2% is a pretty good threshold on a 10-year to look at. That's where our valuation model says fair value is. And so I think we're starting to hit resistance. So it's not too surprising to us that this is where we started to slow the ascent. But it's not a done deal. And so, yeah, if we get a sustained move above 2%, then I think some of these things we talked about would need to be reevaluated, and our models would probably reflect that anyway.
Okay, you guys have a really good chart I want to look at here that is basically 2 parts, and you're looking at yield curve and what happens if it steepens, because given that steepness that we've seen since September, your title this is Why Value Can't Benefit from Steeper Yield Curve. To me, that sounds a little bit contrarian from what we hear a lot given the strength of financials. So walk me through what we're looking at here in this matrix, Ed.
Okay, yeah. So, a lot going on in this chart. The horizontal axis is each sector's weight in the Russell 3000 growth minus the 3000 value. So something way on the right, like tech, that's a growth sector. Way on the left, like financials, big value sector. The vertical axis, it's each sector's sensitivity to the yield curve. So financials are the most positively sensitive, meaning if the yield curve steepens, they're going to benefit. Makes sense. Steeper yield curve, they can make money on their loans. The least sensitive at the bottom are the bond proxies. So if the yield curve flattens, they're going to benefit, which makes sense because they're competing with bonds. So this is the issue with financials, because those 2 groups, financials on one side and the bond proxies on the other, utilities, real estate staples, are canceling each other out. Now, if you go before the financial crisis, this chart looks similar, but there's 2 big differences. One, that energy bubble was a lot bigger. So you had a much bigger value sector that could offset the bond proxies. The second thing is those 3 bond proxy sectors at the bottom weren't as negatively sensitive. So net, steeper yield curve is good for financials. Good for value. Right now, it's kind of an offset. So until the Fed normalizes, this is a challenge for value. Now, one other point I'd make here, this is based on the Russell 3000 value and growth universe. If you're using another instrument, that calls itself value, it could have a different sector relationship, and this may not hold. So it really comes down to knowing what you own. You could buy another value instrument that maybe has more financials and less of bond proxies, and maybe
Totally.
it would work. But you just have to know.
Yeah, no, this is a really good point too. Ed, sorry to jump in, but because we're out of time, but I want to get one more question here because I think this is a really important chart. It also is a great point to remind those to see what tool they're using to get exposure to value, right? Because some funds will have a required type of sector weight or something that's benchmarked to S&Ps. But guys in the control room, let's bring it up one more time because I think the most important part of this, Ed, is that in the Russell 3000 at least, which is stocks, okay, pretty much all stocks, the only one that clearly benefits from this is banks. To me, that presents a little bit of a problem for some of the big rallies we've seen in names like Caterpillar and industrial stocks lately that maybe turns out by your analysis here are actually not that much of value plays. They've been trading in this value comeback, but if they're actually a little bit more expensive than people think, then maybe the run is limited, even if the yield curve does move. To me, that's a little bit of a cautionary tale here about how far the market as a whole can run if we do steepen further.
That's an excellent point. And then what it comes back to is we have another chart that does the same thing, except it looks at economic sensitivity, not yield curve sensitivity. And that's when you see those cyclical value sectors like industrials, materials, they're higher on the scale. So if we get a steeper yield curve because the economy is doing a lot better, then the market can run. If it's just a steeper yield curve because people think the Fed's done and we're not going to get better economic growth, that's not really a great story. And I think the market would run into trouble then.